Nigeria's monetary policy rate has now been reduced from 14% to 13.5%.
The Central Bank of Nigeria Governor Godwin Emefiele announced this decision at the end of a two-day meeting held at the Apex Bank's headquarters in Abuja. This means a reduction lending interest rate by 50 basis points while leaving other parameters unchanged. Members of the Monetary Policy Committee say this will allow for improved credit flow to the country's productive sectors. It also expects this to stimulate the non-oil sector's growth, create jobs, and diversify the economy. Well, joining me from Abuja is macroeconomy policy analyst Ken Ife. Thank you for joining us this morning, Professor Ken. Now, the NPC had maintained an unchanged stance since July 2016, and early this year when they met, they still maintained the stance. In your view, what could have changed for them to, make this reduction?
Well, let me put this in proper context. Last year, by the beginning of last year, the CBN governor raised the possibility that, subject to convergence of some macroeconomic conditions, that the MPR rate, we might see a movement in the MPR rate. So we were expecting this since last year. But unfortunately, as we approach towards the end of the year, there were uncertainties that compounded that decision not to do that. But then bear in mind that we just came out of a political election, and which was one of the things, and the money flow were big concerns. Inflation was going up and down at that time, so you couldn't take those decisions. But now we're beginning to see the inflation go down marginally. And then there are other things that have settled somehow. So there is a bit of confidence that made CBN now decide to make this move. But let me put this in proper context. Now, the U.S. Energy Information Agency predicted that last year the average price of crude would be $72. This year they had predicted just around $62 for the whole of this year. Now, what it means in effect is that our revenue expected from oil will be lesser this year than last year. Secondly, when you have that expectation, then the interest will still continue to be a high interest rate economy. So even though you've got a small movement, don't expect MPR to go down to 10%.
So how would this then support? How would this then support financial growth, and what would be the impact on foreign exchange?
No, the thing is, what we now know going forward is that we need more money into the foreign exchange buffers than we would have expected compared to last year, based on those projections. So we are still going to maintain a relatively high interest rate regime throughout the year. So the movement now to just bring it down by 0.5% is just to send a signal that, look, wait a minute, let's also think about growth in the economy. Let's talk about employment. Let's take, it's just like saying next level. Let's do something.
All right, so then.
It's a signal, it's just a signal. But remember that throughout the last 2 months and 3 months of the election period, MPR rate was not used to tackle the uncertainties in the economy. Rather, open market operations was used much more flexibly to mop up liquidity and all of that. So, but now what you have seen is the foreign reserve is grown to 43 billion, the highest in the last 5 months. Then you have inflation steady, coming down a little bit. You also have revenue showing up. You've got more money coming in from the combined action. The fiscal authorities are doing a good job this time. My
last question to you, Professor, is that what other fiscal measures are required to improve the operating business environment beyond this?
Now, the government revenue has always been the weakest point. So that's why there's alarm on the level of borrowing. But now there's a lot of effort from customs, FIRS, and even the FRC, though they're all making strong efforts now to bring in more revenue. and that gives more cushion for us to borrow more, and then relaxes all sorts of pressures around government borrowing. So that's useful. But then on the monetary side, we are going to see even better stability. If you look at the importer investor window, that's brought in over $50 billion over the last 2 years. That's very encouraging. And the sign in here is that there's more investment flows for the portfolio investment is picking up.
How will this reduction now impact other rates like inflation rates, exchange rates, and all the rates that help to check economic indices?
First of all, let me comment this. Sorry. It's good news. It's good news for investment, good news for business, industry, and employment, in fact, and indeed economic growth. But I have to say that the macroeconomic conditions are positive to encourage the CBN to make such a reduction in the MPR rate. We've seen the inflation trending down slightly. We've seen an uptick in the foreign reserve for the last 5 months, the highest in the 5 months, over $43 billion. We've also seen control of money supply. And even the PMIs, the manufacturers index, purchasers index is positive. So there are a lot of things that are converging and are positive. So that gives them the comfort. But also this is part of a fait accompli, because if you remember, throughout last year, we were all expectant of a drop because CBN was minded to do so. But the conditions were not that favorable. The election coming, fears of influx of currencies and also many other things. So they had to delay that. But I tell you one thing though, why this is an extremely good news for domestic investment. The inflow of foreign portfolio investment is picking up, which means that it recognizes the distance between a positive distance between the inflation and MPR rate, because that is about the real interest rate. So it's positive. So that they will encourage more investors into the economy. And I expect the foreign direct investment to pick up as well. All right, Professor, so, would you see this reduction as experimental? Because from 14 down to 13.5, one would say that is quite really small when you check the margin. Is this experimental? Absolutely, absolutely. You are right. It's actually a signal rather than the quantum. Is the signal. The reason why I say it's a signal is, first of all, bear in mind that the U.S. Information Agency, Energy Information Agency, has predicted that this year the average price of crude will be about $62 compared to last year that was $71. So what that tells you is that we're going to have less government revenue from oil this year, also, in addition to the contraction in output by OPEC. So we will have less. Now, so the counterbalance will come from revenue coming from investment. That's why the MPR rate will still remain high. So you couldn't actually see it go down from 14 to 10, 11. It's not going to happen because of that expectation. So it's just sending a signal that they are concerned about growth, they are concerned about more domestic investment and employment. So it's the signal that is sending. But the reality is this: when we were approaching the election, over that period of uncertainty, the central bank used open market operation more to mop up liquidity so it used that instrument a lot more. And so we should, and even the lending, the net domestic lending to the private sector. Remember that the CBN recently opened up a back door of CRR, that is cash reserve ratio based funding from the banks. Now that opens up to 4 trillion naira.
All right, Professor Kenife.
So that will have more impact.
All right, thank you.
The drop in 0.5%.
Thank you so much, Professor Kenife, for talking to us on this right now. Thank you.